on a big first call it is. My name is Victor Jones, but you're not here for me. You're here for the very special guest, Mr. Tony Batista. Tony, it's great to see you back again on Sunday night, though I must say, my friend, I don't know if it's a good omen for markets. Anybody who's watched Tasty Live long enough knows when Tom is not on the air, what happens to equity markets.
We usually have a big move. And it's been lower the last couple of days for sure. I'm glad you didn't set yourself up for Sunday Bloody Sunday from YouTube or something like that. You know what I mean? You could have gone with that song on the intro, but man, you got Bitcoin lower by 4,000, 4,500 right now on the cash. It looks like. I'm a little surprised because Bitcoin's hung in there. Hopefully, you know what? I'm not really that surprised. I would have thought it'd been 60,000 by now if you're looking at assets selling the way they've sold oil and everything else like that. But it's crazy. You got the pre-market price here 50.50 on the E-mini S&Ps, which shows them down around 46 handles or so. I took an impartial vote before we started here of all the players that are coming on today. Pete was looking at down 30-40. I kind of echo his feelings. You were more in the 60 handle. You're there. Chris and Ilya, our two young guns who will be on later, they were down around 1.5%. They were using percentages. It was going to be so big tonight, but we'll see what happens.
Yes, we got a very special lineup, and just a minute or two, Pete Mulmat is going to join us here, and then we've got Ilya Spivak and special guest this Sunday, Chris Vecchio. So a full house today. Even though we don't have Tom, we got incredible brain power in the Tasty Live universe here today. Tony, I guess just to start off the conversation, a gigantic move in the S&P last week. I would ask you, Tony, as a guy who's seen volatility not once, not twice, but more than a handful of times in your trading career, not talking about price, just going in the mindset that you take going into a week like this week after seeing last week's volatility with the VIX up at 45, forward VIX futures at 32.
Well, I mean, 10% moves happen, every 3 years or so, and I think 20 some odd percent moves happen every 6 years or so. So I mean, you gotta expect it. It's just the velocity of the move this time that's really gotten people freaked out. I don't know if it's like ripping off a Band-Aid. It's better this way or slower the other way. I think slower the other way is probably better for our traders and my style of trading. And you got E-mini S&Ps looking down around 80 right now, new indication, but we'll see how they open. But you had a 3 standard deviation move in VIX up around the 45 handle. You don't see that every day. You had an underwater close. I know Pete wants to talk a little bit about that on the close on Friday. Doesn't seem to be helping the market right here. But I could see us, I didn't think we would be, like I said, I thought it would be down closer to 50. But I could see us selling off a little bit tonight and hopefully rallying into the nighttime and into tomorrow morning. I think they're gonna make it rough for us, Victor. I think they're gonna make it rough for us. What about you?
I think so too. I think every part of me, every instinct, Tony, wants to be a bit. Here we go.
You go down 130.
Opened up
130 and change on the S&Ps,
my friend.
Man, the Nasdaq
down 3%.
529 and the Dow down 800. I said to my son on Friday that I hope you know it. You just witnessed a crash, and you are. I mean, you got to call it. I mean, I think you have to call it the way it is. I mean, this is crash. This is crash mode. You're living through it, ladies and gentlemen.
Yeah, we are finding. Every once in a while, markets go into this sick mode where they try to find max pain. And I think right now, regardless of what you think about the decisions that are being made, we're finding somebody's puke point, whether that's the administration, whether that's his counterparties in negotiation, whether that's the Fed. It seems like the market is going to do its best to go find that point of capitulation for someone. And, again, I would say at the Econ 101 description of what happens is we're sort of an exporter of dollars, Tony. The world takes our dollars for goods, and they use their excess savings of the dollars that we sent them to recycle back into the U.S. financial market via U.S. financial assets. And at its core, regardless of what you think about the policy, we're effectively saying some portion of those excess dollars need to be distributed in a new way. So at its very core, this policy needs a haircut to how to think about equity valuations. And you add a gigantic uncertainty risk premium on top of that. And I think, we find ourselves in a very interesting and perhaps the most high stakes poker game that's ever been played, Tony.
Yeah, you said it eloquently. I'm going to say it like a layman. Friday's action on the close there for that underwater close where we sold off about 60, 70 handles right on the close there. It looked like a liquidation close. And that's why I thought we would open a lot stronger than this, down only 40 or 50 or something like that, because they kind of closed them underwater by about 40 or 50 handles on the 30 to 50 handles on even the S&Ps. And it looked like a liquidation for me. You certainly, from what's going on here, /VX in the 38 handle now, you're looking at a huge, what is that, about an 18% move, 19% move in VIX futures.
We're almost at 5% in the S&P, NASDAQ 5.5%, the Russell down 6.5%, Tony. The Bitcoin
this isn't good for anybody. Like this isn't.
No, it's not.
This isn't good for shorts. This isn't. I mean, obviously, if somebody's balls to the wall short, it's wonderful for them. But any type of position you had on that had any type of gray area to it, even a short delta position, you're long delta already. You know what I mean? So, and if you're a 401k or any kind of passive investor, you're long more delta than you wanted. This is why I always say to people, you got to not only watch your size, but you can't have that mindset. When you sell a put, I'd be happy to own this stock here. Yeah, you wouldn't. You're happy to own the stock there when it's higher. When you place the put, you're not happy to own the stock when it's lower, and the market just has a way of teaching you that lesson time and time again.
Bonds up nearly 1.5 points, flirting with 122. Keep kissing 122. Oil continues its march lower, and we're going to get Pete on in just a second. And down 3%. Natty gas down 1.5%. I think an interesting standout has continued to be gold. A little weakness last week, but it's one of the assets here that's actually hanging in. Copper getting murdered right now, down 7%. Silver down 1.5% as well. So big moves across the board. It really doesn't matter what asset class you're looking at. Gigantic moves in markets here, and
some of the currency's a little bit lower too, but nothing to speak home about.
Yeah. What do you say we get the show started with our first guest, Pete Mulmat, our good friend. Welcome to First Call.
Gentlemen, thank you. Wow. So much for 30 to 40 down.
Pete Mulmat, being the older statesman here on the show, can you
are we grading in months between you and I, my friend? So, but sure.
Can you help us out here? Give us some words of wisdom.
Boy, I think you summed it up. It's just this is definitely markets are thinner, and I think you've got to look at what your size is, and it definitely rings of it doesn't. We'll see how this goes, but a couple points. One is, again, for futures, up and down is 7%. And that's a hard stop for the day until 8:30 tomorrow morning. So if we do go down 7%, and I'm not suggesting we will, the markets will just stay at the offer price. They can always come off that offered price, but if they go down there, they can't go any further than that, which means if you're buying dips and they continue to travel lower, there may be a spot where you can't manage them till the following morning. So be mindful of that. 7% for RTY, ES, and NQ. That is the hard stop until 8:30 the following morning. But Victor, you highlighted things like copper, which they've absolutely destroyed from 570, a new multi-decade high, to almost sub $4 at one point. We got down to 403 this morning. I mean, the bloodbath is pretty much across everything. I would say that the bonds being up only a point is a relatively muted reaction. But 121, 122, we haven't seen that in a long time. So muted reaction, but considering how much we've rallied in the last week and a half, pretty chunky. Dollar, kind of a mixed bag. Euro's a little bit lower. Aussie's low. Commodity currency's going to hit again. Aussie, Kiwi, Canada down. Yen, probably the one outperformer. So we are seeing, it's funny because this hasn't worked a long time. Typical flight to quality, which means bonds rally, notes rally. Currencies like the yen and Swiss have outsized gains, and we're seeing all that play through. I'm a little bit surprised about the scope of the down move this morning, but I think it just speaks to, as we know, guys, markets will go to the point where it can inflict the worst pain, and I think the conviction of, buying this dip as attractive as it is we're in kind of feeding frenzy mode. So. I'm surprised to see this far down.
It speaks to nobody knows nothing, Pete. Is really what it comes down to. I mean, even the young guns, Ilya and Chris, who were talking about 1.5% move lower. I mean, if you see something down 5-6%, I mean, the Russell was just down 6.5% a moment ago. It's down 5% and change. Volatility /VX. Right. Put a chart up there a minute if you don't mind, Victor. It was over $40, 40.20. On the high there. Man, this is volatility like I have not seen in quite some time. Hope I didn't see it again, especially in such a short period of time. But I will say one thing: this will bode, I guess, advantageous is the wrong word to use for rolling down calls here. But you're going to get a high price, and if somebody doesn't have things in the market, meaning money at work now, you are going to get high prices for puts and calls.
Right.
And for those people who are lucky enough or advantageous enough or smart enough to have waited this out, man, you're going to see some pricing like you've never seen in the morning if we hold these down numbers, which frankly, I don't know if it would be bullish or bearish if we do, Pete. Victor, what do you think? Like, I mean, if we rally back overnight tonight, let's talk about that real quick before we bring in Chris and Ilya. If we rally back, and then they can have their opinion. If we rally back here, which would be the first time we've rallied in 4 days, right? Because we have really not had a rally in this market at all whatsoever. Do you think it's healthy, Pete?
Would I trust it? I don't know that I would trust it yet. I think it's like simple math would be, I think earnings right now, expected earnings for the next 12 months, at least they were at the end of last week, or something like $270. And the multiple on the market was 19 and change. And so if you just sort of think, all right,
you think earnings going to mean anything? It's all going to be about their forward guidance and what they say about tariffs or anything.
That's what I'm saying. So what likely could happen from here is you start to see a haircut on earnings and people want to pay a cheaper multiple. That's that's kind of what's happening right now. So the question is, what multiple would the market want to pay, and what discount do you need to put on forward earnings? And if you take something simple like 5 to 10% haircut on earnings, maybe you're getting in the 250 ballpark. And if you just put an 18 multiple on that, which one could argue is still stretched, you're at 45. And we're at 48 and change. We're back up to 49. So I guess I try to look at a mathematical fair value or something within reason, and then I just play the emotional premium or discount around that. And you kind of hope to be in the ballpark. Would it be healthy? It depends on why. If it comes out of nowhere, you could look at that as the perfect conditions for a bear market rally to rip everyone's face off as they try to buy puts on Friday or puts today, and you just you killed everyone's heads off on the way to lower prices. So I don't know that it'd be healthy. And I think in these types of tapes, I mean, the distribution is wide because we could see the most insane bear market rally. And the funny thing is, the entire narrative on TV and in financial journalism will change on a dime, only to find new prices. So I think you got to have some mathematical fair value, some price that you like, and I think you stay small. At least that's what I'm doing. Pete, same question over to you. What do you think?
Yeah,
you get a massive rally today. How do you play it?
I think if we get a massive rally and nobody says anything, we don't get the tweets or anything else like that. I think it's actually if we start to turn, it's constructive. I mean, and let's define a massive rally. Is that getting back to unchanged? Because from a structure standpoint, that's a massive rally from where we are right now, and that's not that constructive. If we get a rally because we get some tweet about, oh, well, we've negotiated with Myanmar or Vietnam.
I had a very good call with President Xi or something like this would be sort of a signal to the market.
That is the rally that'll be destructive because you'll get the algos will jump on that. You'll get 100 points up in SPOOs, and then it'll get taken apart again. So I think if the market can – so I guess what I'm saying is if the market can generate its own value and steam at some point – at these lower levels and hold on to it, that's probably constructive for a little bit of exhaustive run through. I think Christian Ilio will speak a little bit to this too, though. China, all of Asia hasn't had a chance to see this. They'll start trading between 7 and 8 o'clock. It's when Japan and China come in. I imagine, we're going to see the market stay a little bit marked down until we see that take place. But if we can rally without it being tweet driven, it might have some legs. But if it's tweet driven, any rally is going to roll over. And it's going to be hard because you're going to have to accept. We all know there's a new value range, as you said, Victor. We're going to accept the ranges we have. But I think any rallies like that, I'm much more inclined to trust and look at building something onto. I would, from a directional standpoint, those are ones I'd rather fade. And, we've had crude at $60. Go ahead.
Yeah. No. Keep going. Go to crude at $60. We'll come back to the market a quick second.
Yeah, crude at $60. So gold just traded down to $3,000. Silver's down well below 30 to 28.5. So it isn't just U.S. equities; it's a general liquidation, and I think we're going to have to see. We're going to have to see some settling in those markets if you're going to have a lasting equity market rally right now, because there is definitely.
Oh, sorry.
Yeah.
What do you think about gold here, Pete? It's been constructive, continues to be constructive, holding 3,000 here. How do you play gold, or do you play gold this week?
Yeah, and right now, one of the things we've talked about previously is that gold-silver ratio. Number of ounces to silver to buy an ounce of gold. That's at 106 this morning. So well through the 92 that had been the high for the previous 2 years. What is that telling me is that, yes, gold fell $100 on Friday, but silver by percentage has fallen dramatically more, along with we're down almost, 8-9% in copper, down at $4. We bounced a little bit off of that. Platinum, everything else, metals-wise within use cases and industry cases are absolutely getting crushed. So I think we need to see settling in that to help with an equity market rally. And right now, I think gold is trying to wear that safe haven status of a yen or a bond. It's not doing a particularly good job of it, and I've got a feeling that's going to release at some point. So I would not look at $3,000 gold as cheap gold right now.
Yeah, I hear you there. Hey, Pete, I want to, and Victor, you remember 2020, 21 when the NASDAQ was just on that tear like we had been previously, and we got up to around, I think it was 16,500, because I'm looking at the low on the NASDAQ futures here, 16,550. And we got up to around 16,500. It had to be 2021, Victor. Like I don't know, like the end of 2021, and then that year when we opened, we went like straight down to 11,000, like down another 5,000 on the NASDAQ before it took us to the end of the year to get back up to that 16,500 again, where we just I don't know, I'm not going to say bounced off of it, but that's where we hit again. It's really kind of interesting how we've gone down around, what was it, 22,000 is the high on the NASDAQ, down to around 16 and change, that 6,000 or 7,000 as opposed to 5,000 or 6,000 that we went down in NASDAQ. We stopped right at that 16.5 again. I'm not a chartist, but I do remember that number 16.5 when it popped up there. Man, maybe history repeats itself and the old high becomes the new low. That's my words of wisdom for anybody. That's all I got.
Great point.
Yeah.
Pete?
Yeah,
go ahead.
We'll see on this one. You look at crypto too. Bitcoin is, we're below 80,000, but think about that. Considering what everyone else says, everything else is released. It's held in relatively well. Now, Solana's, I think, about half of what it was 6 weeks ago. ETH, about 40%, 60% of what it was a month ago. So they're going after, the edgier pieces of this. So it'd be interesting to see if that gets gone.
Pete, I would have thought that would have happened the beginning of this move.
Absolutely. I would have thought so too. So I don't know. I think it'll be an interesting night. I think you guys hit on the spot of, whether through tonight and tomorrow is staying small is going to be incredibly important. And I think you've got to keep out of your mind a little bit. Sure, you have bias, but with the market moving like this and getting everything I'm looking at my board, except for FX, is seeing levels it hasn't seen in either years or at least a year. Markets will get much more elastic. So you're going to have to be mindful when you get a little bit stubborn and talk about can't go any lower than this, I think, or higher than this. We got to be mindful of that aspect.
One more mindset question before you get out of here, Pete. The mindset question would be, again, something I asked Tony to open the show. You've been through massive bouts of volatility. What type of mindset do you bring into this tape, which has been ugly since February, but obviously the last 3 days have been especially brutal to the downside and the velocity of the move? What mindset do you bring into this week, Pete?
I think, again, a little bit, it's a balanced approach of I'm watching my size. I'm mindful that as much as some of these, from a directional standpoint, these seem like something down 10% a week. It's incredibly interesting. Crude's down, $12 in 6 trading days. That's incredibly interesting. But being mindful of the elasticity there and still being able to manage risk and not getting stuck in stuff. So smaller, more nimble, and accepting the tape as truth rather than just, and not living in hope of, a tweet saving me because they're going to solve this. Don't work from that standpoint. But I think Tony hit on a great point is volatility is there. When you reach across the board, anything you want to go to, be mindful of liquidity right now in certain things if you're looking on the commodity side. But there's volatility is going to be there, and there's going to be a lot of opportunity.
It gives you a little bit of help to stop some of the bleeding. Right. It's not like it's not like a tourniquet. You know what I mean? It's not on existing positions. It's not going to stop the bleeding. It's still going to be just as painful. I have horrible positions that'll be coming in here in the morning too. So, nobody's immune to this. All we can pray, and I can live with the whole scenario, that when Tom gets back into Illinois ground, that the market rallies. He saved the market, right? You now know how powerful he is. Don't mess with him anymore. I can live with that story and bring him iced tea for the rest of my life. I'll go with it. I'm that desperate right now, Pete.
Well, I think the core of the question is when I talk to you guys, and anytime I get the opportunity to talk to former floor traders in the eye of large volatility, what I find incredibly consistent is this cool, calm demeanor. Guys that have seen vol, they've managed vol, they've dealt with vol in the past. And I think, I appreciate that on a Sunday night. Pete Mulmat, I certainly always appreciate it. Tonight more than any, I appreciate you jumping on the call. And I'll see you next week, man. Godspeed.
Thanks, guys. Have a great night.
Thank you.
Gentlemen, have you ever had a 2-for-1, Tony Batista?
Yeah, when I got divorced, after I got divorced, I did, yes.
Well, we've got a special treat for the tasty audience tonight. We got Ilya Spivak and Chris Vecchio, a special 2-for-1 for everyone viewing. Ilya Spivak, Chris Vecchio, welcome to First Call, Jen.
Coast to coast.
Gentlemen, what an intro. Love it.
Let's do this. How about we open super open-ended, because you gentlemen are brilliant. Chris, I'll go to you for your opening thoughts on the volatility that we've seen and the market reaction so far, and then Ilya, we'll kick it over to you for open-ended, sort of monologue at the top here. Chris, your thoughts?
Just a second. I need to finish stitching my shoe. I'm getting some practice in this weekend for the manufacturer. So I'm not particularly pleased with the open, although I can't say I'm surprised. We haven't heard much consistent signaling from the administration this weekend about what the plan is. Elon Musk, of course, has decided to come out against Navarro's tariff approach. Bessent is saying that we have the data to support us. Lutnick's insisting they're going to stick around forever. So pick your narrative. It's not reassuring here, obviously, at the open. We also have to contend with the fact that Chinese markets haven't been open, and now they're going to react to all of the tariff news for the first time. This is not an environment where you want to lay out too much capital too quickly. We are trying to catch a falling knife here, and it pays to be cautious right now. And as we always say, trade small, but be ruthless. If you're taking positions in long deltas and equities, if it turns against you, do not be afraid to cut it and take a small loss rather than a big one.
Ilya, your thoughts?
I think it's really, really important. As bearish as I've been, and as much as I'm on the less painful part of this than clearly most of the markets, which is puking up risk here. I think it's really important not to get married to any of this, and to be nimble, because just because we're so intense out the gate here down does not mean that this necessarily holds through the Wall Street open. Even if you just look at the levels this is scratching at, yeah, you get a massive gap, but there's big levels ahead here. Tony, you were mentioning the highs from early 2022, the start of that down move. We're right there. That was some kind of an inflection point. You don't have to be a technician to look at a chart and go, for whatever reason, the market stopped here and turned here. And people are going to look at that and notice it and see it, especially on a panicky day like today, when people look for answers and go, let me hang my hat on something. So when you look at stuff like this, it's just really important not to over extrapolate anything. Like, just because you get a lot of momentum in a direction, it's wise to stay small, and it's wise not to assume it's going to keep going that way just because the move feels big.
No, you're 100% correct, and I want to take it a little bit of a different direction, because I've read the emails from people and the pain that a lot of people are suffering, and I'm sure a lot more tonight going into Monday if they have. And I know some people have a limited amount of money to put in their account, can't hold positions. I know the newspapers have talked about all the different margin calls and all the other news that you might have. I do want to make one statement here. Let's assume that you had from a trading standpoint, I don't know what the hell's going to happen in the market here. Obviously, I've been completely wrong for the last couple of days, thinking that we'd have a little bit of some sort of pullback. We haven't had one bounce back in the market. So that's the egg on my face. But if you've had a strangle on where a stock has moved exponentially, I mean, you could take any stock you want, but let's just take an NVIDIA stock where, it's gone from around $120, $110 down to around $95 or something like that. And you have a deep in the money put that you can no longer hold on to, or maybe it's an SPX position or an SPY position, and they raise margin on you and you can't hold that position. All is not lost, meaning that if you want to stay in a delta long position, you still can. And I would like to kind of show you how you could do something like that. You could buy back that. Remember, let me back up for a second. long call, short put is synthetic stock, right? You know, if you buy a call, it has 50 long deltas. If you sell a put, same strike, it has selling it. You have 50 more long, that equals 100 deltas. Now, you might not be able to hold that position either with the amount of buying power you have in your account, because it's going to be very similar to the short put. It might actually use less buying power than the short put, but you might not be able to hold it. But if you go down 10, 15, 20, 25, 30 strikes and buy an out of the money put, and create basically a short at the money put spread and a long call naked, you'd have basically synthetic stock. So if you're one of those people who wants to stay with their position, who doesn't have meaning the long delta position, hasn't rolled down the calls through these 3 or 4 days, hasn't stayed mechanical, and still wants to keep that long delta position and doesn't want, quote unquote, you know, the big guys get to keep playing, the big guys get to keep their positions and all this other crap, there's still things that you can do and use a lot less buying power by doing that. So it's going to stink, it's going to hurt, it's going to sting, and it's going to be probably the worst trading day of your career if it's been a short career, but you don't have to cash in all the chips and walk away if you don't want to. Now, again, the whole caveat here is if you don't want to. So that's the public service announcement that I want to make, because obviously, Victor, you can say, you know, all the experience you want in the market. Like I told Pete earlier, nobody knows nothing. That's really what this comes down to.
Yeah, man. The hope for the rally to get you to bail you out of risk that you don't want is likely not a strategy, and the market just knifes you even deeper. So I'm sure there's a lot of people out there, Tony, that appreciate the guidance. I wonder, Chris, I'm going to come back to you. I guess, were you surprised in any way what you heard out of Jerome Powell on Friday? And what do you think the calculus is for the Federal Reserve, given the uncertainty in the markets, given their responsibility for emergency liquidity, given the state of credit markets, the relative demand for treasuries? Were you surprised in any way what you heard from Jerome Powell? What's their calculus going forward from your point of view?
And sound.
Sorry about that. We've been talking, Ilya and I have been talking about this, for several weeks on Overtime and Futures Power Hour, how as Fed observers, we've come to learn, and they articulate as much, they are not a proactive institution. They react. And right now, the hard data does not suggest that they have any reason to act. So until we see something that gives them a rationale to do something in May, the market's not going to get help from them. Inflation isn't soaring, although expectations are higher. Growth isn't cratering, although growth expectations are lower. And so they can't really move right now. But when they do move, they're going to wait to see the growth decline. They have repeatedly said that they're more concerned with a decline in real output than ultimately inflation. But the tariff implementation could drive inflation to levels that are well beyond what the Fed thinks that they should overlook. And that's really the problem here. The modeling that's been coming out from various hedge funds, banks, nonpartisan institutes over the last few days suggests that we could be looking at inflation going back to the COVID highs this year if these tariffs are implemented and held all year round. And that's not an environment that the Fed can even think about cutting in, even if growth is falling apart and we see a decline in employment. So, market close tomorrow. Tuesday could be a really bad day for a lot of people. Vic, I think that you pointed this out the other day on a tweet. People don't realize it yet, but it was last Thursday that millions of people may have lost their jobs. So hopefully it doesn't come to that.
Yeah, the market is clearly pricey in discounting sort of a new global trade, new money flows for the entirety of the world, and likely discounting growth or the lack thereof, the slowing down of growth into the coming months, likely discounting a bunch of CEOs that aren't going to want to get in front of investors and overpromise in an uncertain environment, so they kitchen sink their guidance. I think the market is discounting all of that, and there's a response that comes. It doesn't come the first day, it doesn't come the first week, but eventually these numbers start to get reflected in the real economy. Same question to you, Ilya. What's the Fed's calculus from your point of view? Similar to Chris, or any nuance there?
Well, I think what the Fed really has to see is they need to see a reason why they need to act immediately. And if you look at what they said at their last FOMC, you really get exactly what the balance is. Powell came out in the press conference after the last FOMC, said, look, we know that tariffs are coming. We don't know what they're going to look like. We know that historically they're a boost to inflation, which may be a one-off, maybe not. We know it's a hit to growth. That's what we have in the forecast. We'll wait and see. He came back on Friday and said, okay, so the tariffs came. They were a little bit larger. The calculus remains the same because they were a little bit larger. Maybe the inflation piece is a little stickier than we thought. But if you look at what the market is telling you, 5-year break-evens, they're telling you that this is a recession because they're falling. Inflation expectations are not up, they're down in the market. All of the rate cuts that the markets had baked in, the totals haven't moved very much, but they've all moved to 2025. So if you look at what Fed funds futures have right now, it's 125 basis points in rate cuts this year and nothing next year. So everything that was maybe about a 50-50 split, if you ask the Fed, a little bit more like a 70-30 split if you look at the markets, even at the start of last week. Now it's 5 rate cuts this year. The recession is on. And it still hasn't shown up in the hard data aggressively. We'll get CPI this week. That's hard data. And inside of there, you've started to see some rumblings already over the past 2 months or so. I don't think the Fed is in emergency meeting mode right now. Because at this point, the dollar is selling. Interest rates are coming in. It's still, you've triggered recession. The Fed will cut. Things will normalize. This is not hair on fire. The credit spigot is closed kind of panic. It is worrying, though. And I think we talked about this last week, Vic. When you start to see gold and stocks sell at the same time, that tells you that it's a panic. And people are cashing out, and they're just selling everything that's not nailed down. And it doesn't matter. We're starting to see some of that here. I don't think we've reached fever pitch, but it's starting.
Gold selling off the way that it did is the problem.
Real quick.
That's the issue.
Yeah. Real quick, and I want to come back to both of you, and then Tony, go to you for words of wisdom to take us out. But like credit spreads, they have started to widen out a bit.
Yes.
But I agree with you. The Fed doesn't respond to equity prices. They respond to treasury market dysfunction, and they respond to unemployment. And while the market might be handicapping a lot of that showing up in the future, what you guys are sort of outlining, Chris is saying they are reactive, not proactive, is that your price is going to show a future world well before economic data is going to validate the price action of today. And what Ilya is saying is we've got perhaps a wedge of time between now, the market discounting the future, and what Chris is saying, the ultimate economic data bears that all to be true. And in that middle time, we're just going to be looking at a Mr. Magoo Fed who's waiting for the data to tell them to act, or the forcing
unless credit markets seize. And if credit markets seize up, then the emergency red phone gets activated. But we're not there yet, and so for now, there is no safety net.
I mean, if only Victor, for a way for people to follow that at home, you can look up the BBB OAS spread. If you type that into Google, it'll give you a link to the St. Louis Federal Reserve Economic Database. The BBB OAS spread is one of those signs of credit stress in the market, compensation that you need to hold risk effectively over treasuries. Mm-hmm. So as that widens out, I mean, that's not at super high levels right now. It's its highest level since August, right? And it's not even passing the August highs. But as that goes up, credit stress starts to build.
Yeah.
Mm-hmm. I think if Tom were here, he wouldn't shy away from his opinion on the matter, on sort of the market's opinion on the catalyst of volatility. I guess I'll ask you guys the same question. We can go around the horn here. What do you think? I asked you the calculus of the Fed. What do you think the calculus is of the admin from this point going forward? What effectively? What are the potential outcomes? Right, countries come to the table, they negotiate, as sort of Argentina did, tariff-free trade. Countries group up. and they retaliate as a group, as a larger trading bloc to put maximum pressure. Trump's favorability holds in. Trump's political favorability erodes. All of these things are sort of a calculus and a stew of how to think about risk and potential outcomes under the distribution. I wonder if any of you guys have strong feelings on the calculus of trade as we go forward and how that impacts price. Chris,
I'll go first because I'll be the most Neanderthal of all of it. Countries can't get together to stop killing each other. You think they're going to get together to help each other? No freaking way. It doesn't matter. What's going to happen and what will eventually happen is you're going to negotiate. And we all, I don't know if we all, when you negotiate with a loved one, you don't come out and say exactly what you want to say to get your point across. You say what you would like them to hear with a little bit of what you would like to say, and you work your way from there, and you try to make a deal where both people feel like nobody won, but they're both in a better place for the unity of everyone. To Trump's detriment, I believe what he's done here with these tariffs, he's pissed everybody off. Tom called it self-inflicted. I'll go with that saying, and nobody liked the tactic. But we're all going to have to come to the table someday and figure this out. Not for the stupid stock market, because it has to be figured out for humanity. And that's what will happen. Now, I hope it happens sooner rather than later, but Fed meetings and all the other crap is all, and earnings are all going to take a back seat to all of this news, in my opinion.
Yeah, to Tony's point, I think the optimistic way to look at this is that tariffs are the forcing function that offer the U.S. admin a carrot to provide the rest of the world, which is a reduction or an elimination of the tariffs in exchange for another trading parties lowering their existing tariffs, or an investment in America in capital expenditure instead of those excess dollars coming into America and going into financial assets, which probably disproportionately benefits a certain group versus more widespread distribution. I think that's the optimistic view. Clearly, there's given a wider distribution. There are other points of view here. Chris, we'll go to you, and then Ilya, back to you.
I agree with Tom. This is a self-inflicted wound, but the reality is, and having now officially COVID-free, I decided to collect some anecdata today and walk around town and talk to small businesses, grocery store, liquor store, clothing shops, pharmacy, about how the tariffs are impacting them. And the reality on the ground is that most of these businesses have 4 to 6 weeks of working capital. Their non-perishable items are in the supply chain, fixed inventory costs for 3 months. The perishable stuff is about 4 to 6 weeks out as well, depending upon where you're going. For drug supply, it's much shorter. And the reality is that if these tariffs go into effect, businesses are talking about shutting down, closing working hours, laying people off, because they will not be able to operate at the margins they're operating on. And that includes grocery stores, which operate at 2 to 3% margins, which is why all this talk about price gouging at grocery stores and that's so ridiculous. They're not making a ton of money. You can see it in their earnings reports. They're clearly not price gouging if they're still only making the 2 to 3% earnings. But that's all out the window. And so there have been myriad reports. You can see it from various startup owners, various manufacturers here in the United States, that if there's no clarity in this by end of day tomorrow, they're going to have to start laying people off. And that is awful. And so I don't know if thousands, millions of people losing their jobs is the right way to go about this. If we really want to reshore manufacturing, it's a shock to the system. This is a shock to the system. So I'm not looking to buy any dip right now until I get the big guy himself giving a signal, because there's no one in the administration that's giving us a clear talking through, and there's just mixed messaging from everyone else except for Trump at this point in time.
Ilya, your thoughts?
I think Tony is right in the sense that from a geopolitical perspective, there is no alternative to the U.S. consumer market. There is no alternative to the U.S. dollar and global commerce that can get turned on overnight. It doesn't exist. And so everybody, for the sake of their own skin, is encouraged to stem the bleeding. And given how we've seen the example present itself with Mexico and Canada, you can see that it can just be a phone call. You don't have to necessarily come to the final agreement. Sometimes you might be able to just call the White House, have a nice conversation, say the things that you need to say, and things get put on ice because it's that fast and it's an executive order. So maybe there is an outlet there. But to what Chris is saying, none of that prevents the ripple effects of the shock from being felt in the real economy, even if there is a surface level, kind of macro level agreement. And when you look at the way that the markets are behaving here, they're very clearly showing you that they're able to hold both of those ideas at the same time. They're not locking out credit markets. There's not a panic, but there is a pricing in of recession and imminent easing. So what they're saying is, we're not going to collapse capitalism here. We're just going to go into a recession, and it's going to be nasty, and it's going to need easing. And I think that becomes more a story about how do you run for midterms? How does the makeup of Congress change afterwards? What is the political punishment? And how quickly does that abort this agenda? Rather than it being, oh no, we've crashed the world economy, things are going to come apart at the seams. That's not what the markets are afraid of, at least at this point.
Hold on, I gotta give both of you guys. Let you talk, and I didn't interrupt either. I gotta give you a little bit of pushback. Both of you say there's been no price gouging. I don't know what world you guys live in, but things are up 25% over the last 2 years. I mean, you got to stop, man. Like, you're just talking about the here and now. Like,
no.
This is
price gouging is a specific term when businesses explicitly raise their prices to capture the ebb and flow in supply and demand. It's like dynamic pricing in real time. We've seen through Kroger's and Walmart, like, their margins on the groceries have been 2 to 3% going back to 2019. So they've raised prices, but they're doing it to keep their margins intact. The prices that they're paying for everything is going up.
It's 6 of one, half dozen of another. So you're saying price gouging? You mean when this pen used to be $1 and now it's $5? That's a price gouge because everybody needs a pen. You're taking the literal form of a word, price gouging, and say prices have been going up for the last couple of years.
Yeah,
it's finally coming to an end. You tell me 2 years ago, somebody just wrote to me, it's a great quote, that the thing to do was to buy Range Rovers and sell Teslas. Like, nobody had this on the scorecard. I mean, guys, to think that you can make a logical answer for something that's illogical, it's hard for me to swallow. I mean,
I have no idea
I have no
about
conviction.
Price gouging or not. No idea whatsoever. But what seems to be the case is that prices went up such that it was uncomfortable enough to generate a political outcome. Mm-hmm. We now are looking at some of the consequences of that political outcome, and now there will be pushback
of doing something about it. Now, I don't know if it's right or wrong, but it's doing something about it.
No, sure. Right. Sure.
And I mean, I wasn't a COVID expert. I'm not a tariff expert.
I think we should be able to
I don't even think I'm a trading expert anymore.
No, those should be ideas that we can hold in our head at the same time. That obviously enough people thought that things were ridiculous that they acted accordingly. And then the action taken to address the ridiculous maybe is not the optimal action.
Yeah, I think I don't usually give my strong opinions on this Sunday night show. I'll dip my toe in the water a little bit.
Before you do, Victor, CNBC is having a special tonight at 7 p.m. It has not been confirmed whether or not it's markets in turmoil.
Please tell me it's markets in turmoil. I got to know if I got to get out of my shorts.
Real talk.
Seriously.
I think this isn't a license to buy indiscriminately at levels that don't make sense. But I do think the hardest thing is to buy them when everyone else hates them. Mm-hmm. And sometimes the hardest thing is to sell them when everybody else loves them. And this is a period of time that is developing into it's a period of time when not a lot of people like them, and they might start hating them. And I would say, for a trading point of view, you probably want to be on the right side of that trend. As an investor, you probably want to be on the opposite side of that trend. And I think if you're 30 years or younger, and you're lucky enough to maintain employment through a growth slowdown, I think a lot of those 30 and unders should be maxing out their 401k contributions or starting to look at doing something like that and getting aggressive with capital allocations if you're young. That's number one. Number two is, I think from a political point of view, however you feel about the tactics, the reality as a country is our risk profile all looks the exact same. We kind of all need a really good outcome from what's happening right now. And if we don't get a good outcome collectively, we're going to experience pain collectively. And I think it's important to remember that. And the third thing I think is, I think there are a group of people of 50%, at least 50% in the country, who felt there was a problem with distribution of money and wealth. And I think if you come at the world from that point of view, then like fixing it, no matter how you try, is going to come with pain. If you implement a wealth tax, all the people that are in favor of a wealth tax, you're going to make wealthy people sell their stocks to create liquidity to pay their wealth tax, and you're going to have a downswing in the market. If you want to go through something like this, more exotic, you've got to pay the tab for big types of reform, whether you agree with it or not. And so I'm not, regardless of what you feel about this and you think we should take another tactic, the truth is, if you actually want to do something about that distribution, it's market negative any way you slice it. Just pick your poison. Pick the policy that you want to put in place. So I think those are my three comments. Chris, how do you think about risk going into the week? Is there any part of you that's sort of itching to figure out where you can start deploying a little bit of risk capital, either on the trading side of your accounts or the investing side of your accounts?
The investing side, I'm thinking about Google and Meta quite a bit. I don't know if people are paying attention to Meta's AI numbers over the weekend, but they may have just produced the best rated, lowest cost model out there. Zuck put it out on Saturday, and people were wondering, why did you put it out on a Saturday? Well, that's when it gets done. You ship when you're ready to ship, folks. So I would keep an eye on Google, 15 times PE right now as a longer term ad. That certainly intrigues me, but that's more of the long-term holding account, as it were. In terms of the trading, these are some of the worst markets I've seen. The fact that gold gets clobbered tells me that we've seen some shops blow up. Funds are getting liquidated left and right. So even the winners can't hold on. I would pay more attention to the names that held up on Wednesday afternoon and Thursday, as opposed to the ones on Friday, to see where there might be some ability to claw back, like your consumer staples or utilities, for example. That's probably the place to look first off if we're going to pick a bottom. But if Trump tweets anything, right, he says something, this could be a nasty face ripper to the upside. And, that's really all there is to it. I feel bonds and the yen and gold still are my most comfortable places to be right now, given the state of the world.
Low vol, low beta assets, says Christopher. Chris, what do you think about, to the opposite end of your barbell then, what do you think about Bitcoin? Because that would be the opposite. It would be high vol, high beta. It broke down. What do you think about that end of the barbell?
So during crises, the first thing that usually moves are all the good stuff, because they're the ones that you can get people to buy right off the bat. No one wants to buy the crap when the market's going down. Bitcoin is also more heavily retail than institutional. And so when you think about the profile of the average Bitcoin hodler, it's more likely to be someone listening to this podcast than someone who's making decisions for a pension fund. So to that end, retail is typically late, of course, on these things. And the fact that Bitcoin is now just capitulating shows that maybe the message is getting through. I'm curious to see what the positioning update in the COT report is actually for stocks this week, because we had swung from being long and getting longer through the dip initially in February and March to where we started to get out. So perhaps we're heading into liquidation territory, but we've seen some very big trading volumes. Crypto is not offering you that green shoot that you want to see right now. So unfortunately, I'm going to be cautious, staying cautious.
Ilya, same question over to you, man. Trading and investing mine. On the trading side, how do you deploy risk? And then what's in the back of your mind from a longer-term investing point of view?
I mean, on the investing side, I think, and we've talked about this before, you kind of have to trade from the perspective or invest from the perspective that Armageddon isn't coming. Because if Armageddon is coming, then what's the point of investing? So I think you sort of have to be forever long and not touching it and playing the averages over time. From a more tactical near-term perspective, I mean, I'm very long the long end of the curve at this point. I got out of my dollar shorts last week, but I've nibbled a little bit long the Canadian dollar here. I want to be short more dollars. I think there was a pullback, but ultimately, if this is going to be not a panic, but just a recession, which is sort of my base case here, and recessions occur. We've seemed to have forgotten that it doesn't have to be an '08 meltdown or COVID. We could just have a recession. And so that's sort of my baseline here. So I want to be short dollars. I want to be long bonds. I want to be long yen, and sort of put all those things back on after clearing out mid last week. As far as equities, I am being very careful about where to exit my shorts here because I have a bunch of short NASDAQ, a bunch of short S&P that I've had for a while. And for me, it's not giving it away because of a rapid rebound, because I think you have to be cognizant and you have to understand that the stock market doesn't like going down. Whereas other markets are two-way markets, stocks do not like the downside. And they're going to try to hang their hat on something. They're going to try to find the point here. And so, and we're getting into levels that are of significance. So for me, it's not leaning into even more shorts or trying to chase this. It's where do I get out? And if there's a bounce, at this point, I'm looking to sell another bounce, but I have to be very, very careful here and not over extrapolate into hair on fire, end of civilization type of thinking, even though it's working, because that gets you into trouble every time.
Yeah, Victor, S&P is at the uptrend from the COVID swing lows, from the low that we had in 2020 and 2022. So, for the people feeling frisky out there right now, if there was ever a technical place for the market to bounce, I suppose this would be it.
Yeah. Look on a weekly, look on a monthly, you can really see, I mean, you're right there.
I can't wait till you guys talk about in the coming days, months, or year how oil is lower. It's not inflationary. It's helping the market. Interest rates are lower. It's helping the market. That's going to be your spin on that. I'm listening to you guys because it's easy to see with the market down 5%. But I'm going to go back to 1987 and years past then. You trade for tomorrow. You don't trade for today, meaning, as you guys have both said, everybody has said, you keep it small, but there are opportunities abound. It could be long or it could be short. I have no idea what it's going to be, but there are opportunities abound. As a trader, any short delta I have put on over the last 2 or 3 days, because I always do both sides, has lasted for about an hour and a half because the market has not had one uptick and has not had any vol contraction. So unless you're just trading futures or out and out buying puts, it's been a disastrous trading experience for even the alleged most amount of time trading on the show tonight. So I'm going to tell you, it's been a struggle. It's been hard. I don't know if we're going into a recession, not a recession, but I can't wait to hear about the other side of the coin someday. That's the day I'll be the happiest.
Give us markets in turmoil tonight, Tony. I'm buying leaps before the evening's over. Okay, 7:01 p.m. I see that cry on.
Oh yeah.
Tom usually asks. I usually ask Tom to give us words of wisdom to go out. I was going to ask you to do the same, but I honestly think that was such a beautiful ending to the show. We went a little bit longer tonight, given the larger audience. I think the amount of questions we had and trying to answer some of those on air. So we want to thank everybody working behind the scenes, all the production crew for staying with us an extra, 20, 25 minutes or so. If you have questions, you're looking at your brokerage statement that you just got from 5 days ago from your advisor, and you're wondering what the hell they're doing, you can do that yourself a little bit better. I think there's a lot of people out there who have questions and not a lot of people who have answers in the face of volatility. This isn't voodoo. Nobody can tell you an exact price, but we can help you to learn how to deal with volatility within the distribution curve, and that's the benefit and the value proposition of Tasty. So lines are open, and we're here to help. Feel free to contact us on social media. Like this video if you haven't already. Send it to anybody who you think might benefit from the content in this show. Subscribe to the channel if you haven't already, and we've got something for you. If you're a little bit nervous and you're watching the markets overnight or no matter where you are in the world, we start content 1:30 a.m. Central Time. So you got questions, we'll be here to help answer them, whether that's through the brokerage side or the content side. We will see you back here tomorrow, everybody, for the incredible and experienced Tony Batista, for Ilya Spivak, the incomparable big brains of Ilya and Chris Vecchio, and Pete Mulmat. I want to thank all of you on their behalf and my own. We'll see you back here tomorrow, same time, same place, same great network.
Peace out.
Peace.
Peace.